Hey everyone, this is Kirk here again at optionalpha.com, and in this video I want to go over the differences between margin and cash and how those relate to trading, because as you start setting up your account, you might have set up, or you may want to set up, a margin account that you can trade with. And margin is basically just a very complicated way of saying that the broker is going to take other securities in your account and kind of use them as collateral to make other trades. And it's a great way to reduce the buying power effect or the drawdown in your account to make a trade. Now, this type of additional leverage also creates a little bit of an issue, because then it leads some traders into trading positions that are way too large for their position or for their account size. And so you just got to be careful, as always, with leverage. It works great when it's in our favor, and it also can work exponentially bad against us if we over leverage our account. So on the screen here, I have two different examples. This example up top, this is my margin account. So this is my margin trading account, and we did the exact same trade in both accounts and kind of set this up here so that you guys could see the differences between them. And then down below, you can see it's the exact same order. It's just this is my IRA account. So now you have the differences between cash and a cash account, which is an IRA or an investment retirement account, and a margin account. Now you can have cash investment accounts that aren't retirement accounts, but in most cases when you trade options, you'll want to open up a margin account, because that will allow you to get the smaller buying power reduction for each trade that you do. And again, it just becomes a better use of your capital. You don't have as big of a drawdown. So let's go over the example. So again, up in the top, this is our margin account. In this case, we just sold one Tesla 200 strike put for $11.10. So here you can see that the credit, or the max profit we receive if Tesla worked in our favor in this trade, then would be $1,110. Now it's important here that we notice that the max risk in this trade, if Tesla does go all the way to zero, is $18,890. Now again, this is the risk if Tesla goes to zero. It's not the real risk. The risk that Tesla goes to zero is minimal, if not nothing, because it can't be worth zero at this point. And so this is the risk of the trade, but because it's in a margin account, we are only required to put up as collateral $3,800. So this is our buying power reduction because we're in a margin account. Now what happens is that the broker uses other securities or cash that you already have in your account and kind of collateralizes them against this position. So this won't mean that your only risk is $3,800. That's just what you're putting up initially to cover the position. If Tesla starts to move against you, then this margin requirement can go up, because the position starts to become more of a losing trade, and so the broker is going to start requiring that you keep and carry more and more capital in your account. So one of the biggest things that people always have in misconceptions is that this is the initial investment and this will be the only thing I can lose, and that's just not the case. You do have risk that is beyond this, but the broker is not requiring that you put up that amount of capital up front. So this is why I always suggest that people kind of have an absolute reserve figure in their account in some form or fashion. This absolute reserve amount is kind of this big chunk of cash that you have in your account. It can be 40 to 60% of your account that you just sit there, because in cases like this, if margin were to expand and the broker would require more money, you want to make sure that you have that in your account available to cover that trade. Again, now don't get too scared about using margin. Margin is a great thing. We just have to understand how it works for our positions. All right, and down below, you can see this is the exact same trade, except we did it in our IRA account. I kind of set this up in here, and you can see the stocks trading at the exact same amount. Everything's exactly the same. We're taking in the same $1,110 credit. Now, notice in a cash account, what you have to do, and this is specifically for IRAs and retirements, you have to cover the cash value of your risk. So in a cash account, like a retirement account, the broker doesn't allow you to margin some of your other positions. So notice that our max loss here of $18,890 is exactly the same amount as how much we have to put up to initiate the position. Now this means, on the other hand, like a margin account where margin can expand, in this case, since we're covering the entire risk of the trade up front one time, this number, 18,890, is all you will have to put up on this position because it's the most that you can lose on this position. Everything in. So the broker is not going to require any more to be put up in that position. But now you can clearly see, using the two different examples right here, why a margin account just gives you a better use of your capital, doesn't tie up as much capital, but also how a margin account can really negatively affect you if you over leverage and over allocate some of your positions. So make sure that you read through our allocation guide that we have here at Option Alpha. Go through it in detail so that you understand what we talk about when we talk about absolute reserves and making proper position sizes, because it's not just enough to understand what margin is, you have to be smart about how you use it with your trades. So as always, if you have any questions on margin or cash accounts, please add them right below this video in the lesson page. And until next time, happy trading.